Think of an investor. England in the 1840s. The newspapers are full of advertisements for railway companies. Everyone is buying, everyone is winning, and everyone wants to buy more. His neighbor bought, his colleague bought, and there are even those who found money from forbidden sources to buy. This man buys too, because not buying seems like stupidity, because everything is only going up. Then one day, everything goes down. Suddenly, rapidly, for everyone at the same time. That man did not just lose money, he lost something else, his belief that new technology automatically means profit. This loss was one of the most valuable lessons in financial history. But many who took the lesson lost more than they learned. The railway mania is one of the most interesting episodes in financial history. This is because it says a lot simultaneously about the true value of new technology, the speculative bubble, and the irrationality of market psychology. In the 1820s, the first railways began operating in Britain. When the Manchester-Liverpool line opened in 1830, it became clear that a transport revolution had begun. Cargo arrived in 1/10 of the previous time. Costs had decreased sharply. Opportunities had expanded sharply. This reality attracted investors. Opening a railway company was profitable. It was proven, it was visible, and it could be measured. The first investors made real decisions based on real value. Their profits were real too, but real profits awakened a speculative appetite. Soon company prices began to decouple from their fundamental value. A share in a railway company no longer valued that company's real income, but rather people's dreams about that company's future. This moment of decoupling is the starting point of every major financial bubble. In the 1840s, the British Parliament granted licenses to hundreds of railway companies. Every city, every village, and every region wanted its own railway. Companies were established, shares were sold, and money was raised. But a large portion of these companies were not working on any real project. They were only a promise of something that could be built, perhaps built in the future. Investors bought this promise. Why? Because everyone around them was buying. Because prices were rising. Because not buying looked like missing an opportunity. This psychological mechanism, making decisions based on the behavior of others, is called herd behavior in economic language. But whatever the name, the result is always the same. In 1845, prices reached their peak. In 1846, cracks began. In 1847, a total collapse occurred. Shares of hundreds of companies became worthless, and thousands of investors went bankrupt. A large portion of the projects licensed by Parliament were never completed. The money was gone, and the railway did not come. This collapse was not just a financial disaster. It was one of the birth moments of modern financial regulation. Parliament realized that granting a license to establish a company was not enough. Standards were needed to protect investors. A company must have real capital. A project must pass real technical expertise. Financial disclosures must reach the public. These requirements seem ordinary to everyone today. But in 1840s Britain, they were revolutionary. The crisis of the railway mania tested the basic principles of financial regulation in practice, painfully but irreversibly. The technological dimension of the crisis is also interesting. The railway itself was truly a revolutionary technology. The problem was not with the value of the technology, but with how that value was appraised. It was difficult to distinguish between a real railway company and a railway company on paper. Both looked the same, both said the same thing, and both made the same promises. This problem of distinction became a persistent question in financial history. How can real technological value be distinguished from a speculative bubble? In the 1840s, it was the railway. In the 1920s, radio companies. In the 1990s, internet companies. In the 2020s, cryptocurrency. Every time it is the same model. Real technology, excessive speculation, and inevitable correction. Another interesting aspect of the railway mania was its consumer dimension. This was not a crisis in which only professional investors participated. The middle class, teachers, doctors, small traders also participated. Many of them were stepping into the financial market for the first time. The railway opened this door for them. This democratization brought one benefit and one harm. The benefit, investment opportunities, spread to a wider mass. The harm, inexperienced investors were exposed to great risk without a protective framework. Both left a mark on the formation of the modern financial system. The long-term result of the crisis is interesting. The railways themselves did not collapse. They were built, they worked, and they changed the economy. The collapse brought down the companies and bankrupted the investors. But the real infrastructure remained. The next generation benefited from those same railways, on the tracks built by the money lost by the previous generation. This paradox is a persistent pattern in financial history. A speculative bubble often overfunds real infrastructure. When the bubble bursts, investors lose, but the infrastructure left behind continues to serve the economy. The internet bubble was like this. Companies collapsed, but the fiber optics remained, the internet remained, and the digital economy remained. The railway mania brought the question that lies at the heart of every major technological investment wave today to the agenda sharply for the first time. If the technology itself is valuable, is investing in that technology necessarily meaningful? The answer, as the railway taught us, often depends not on the technology, but on the valuation. When you see a new technology, artificial intelligence, quantum computing, or anything else, what is the first question? Is the technology itself valuable, or the speculation surrounding it? If the railway mania showed how difficult it is to find the answer to this question, what tools do you think exist today to find that answer? If such questions are the kind that make you turn things over in your mind, how technological revolutions shake financial markets, and the fine line between speculation and value, this channel is exactly for that. Subscribe. Every week we dive a bit deeper into the stories that shape the world you live in today. If there is a moment in financial history you have always been curious about, write it in the comments. The next video might start exactly where your question ends.